as of Friday, the market had priced in 7 rate cuts. Now, there's only 8 meetings a year. And the January meeting, there's got like a 4% chance they're going to cut rates. So that must mean that every meeting this year, they expect the market expects the Fed to cut rates in an election year. And people say, yes, because it's an election year. And yes, Powell remembers all the mean tweets and he doesn't want that guy back. So he's going to cut rates to try and help the other guy become president. That's the cynical argument. But I've always said, yeah, hold on a minute. He could cut rates to help the other guy, but if he cuts rates and we have inflation, it blows up in his face and he makes it worse.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. Rumors are suddenly flying fast and furious that the Federal Reserve will soon be ending its campaign of quantitative tightening, aka QT. This is on top of the 3 rate cuts it recently guided the market to expect in 2024. Is the end of QT indeed imminent? And if so, what will the implications be? To discuss that, as well as the other major macro trends expected to impact markets most in 2024, we're fortunate to sit down with analyst Jim Bianco, president of Bianco Research and proud creator of a new ETF, the Bianco Research Total Return Index. Jim, thanks so much for joining us today.
Oh, thanks for having me.
Hey, always a pleasure. Congratulations on the new ETF. We'll talk about that in a few minutes here. Lots of questions for you. Like I said, I want to get into the whole, is QT really ending, in the near future in a moment, because everybody's abuzz with that right now. But before we do, let me just kick this off with a general question I like to ask you at the start. What's your current assessment of the global economy and financial markets?
So I think as we sit here and talk, the economy is actually okay. It's probably growing a trend, if not slightly above trend. That's where it was in 2023. There's a problem with that statement, though, because if you're growing a trend or above trend, that's going to give you a lot of demand, and that could be a push on inflation. So the inflation rates come down from 9% to 3.4 using CPI year-over-year basis. And a lot of people are using this phrase that we're in the last mile. We're on our way down to 2. I'm thinking we might have already seen the last mile, or very, very close to seeing the last mile. Inflation rate actually bottomed at 3.0% back in June, 7 months ago. Now it's 3.4. If the global economy stays relatively okay, I don't want to say a boom, but not a soft landing or not a hard landing, that'll put a little bit upward pressure on inflation, and that should keep inflation sticky, and that should, maybe frustrate this idea that the Fed's going to cut rates a lot of times, interest rates are going to come down more than people think. Then, on top of that, if you throw in some of the exogenous problems that we're seeing, say with Red Sea shipping, possibly a turn in the housing market north, yes, a turn in the housing market north by some of the data, you could definitely see a frustration that the Fed may not wind up cutting rates 5 or 6 times. So I'm a bit optimistic, and I understand that that's kind of an outlier opinion. Bank of America, the day we're recording, put out their global fund manager survey. 59% of their fund managers expect a recession in the next 12 months. I just participated in the Roundtable Prime at Double Line's offices in Los Angeles last week. Majority of the people there were very worried about the economy as well, too. I was less so worried about the economy and more so worried about inflation.
Okay. So taking away from that, it sounds like you are guardedly bullish. Is that a fair term to use for you?
Guardedly bullish on equities, you mean, or on the economy, or on
I guess
bonds?
I'd say the economy. It sounds like you're guardedly bullish on. I guess we'll get to markets in a moment. Obviously, what'll depend on, part of your answer is going to depend on what happens with inflation. You kind of like you're keeping an eye on it. But right now, it sounds like you're kind of guardedly bullish about the system. Feel free to correct that in any way.
No, I am guardedly bullish. I am guardedly bullish on it because I think what's changed about the economy post-pandemic, one of the things I've argued is that every so often we have these major events, the financial crisis, the lockdown restart, and I use those words because that's really what the event was of the global economy. that it either speeds up or changes trends. And I think it's changed some of the trends. We know about the remote work trend, but one of the things that it also seems to have changed is this attitude about spending. 2010 to 2020, coming out of the financial crisis, equity markets went up, home prices went up. To keep the example simple, you got your brokerage statement, you looked at it and you said, wow, I got more savings because my portfolio went up. What are you going to do about it? I'm going to feel better about my financial position because I've got more savings. Today, you look and you either get a check in the mail from the government, or you look at your portfolio and it goes up as the S&P pushes all-time highs, or Zillow tells you your home went up, and you go, oh, look, we've got more savings because that went up. What are you going to do about it? I'm going to go to the Bahamas. I'm going to buy a new car. I'm going to do something with that money. That's what's changed. And that's why I think that inflation is a little stickier than we've seen in prior instances. And that's why whenever I bring this up, people always say to me, yeah, but when the stock market boomed from 2010 to 2020, it didn't produce inflation. Yeah, because we weren't in a spending mentality. Today, we are in a spending mentality because if you look at the last 6 quarters or so of the economy, spending has been one of the things that has really surprised everybody. Their economists would argue, oh, that's the post-pan excess savings from the pandemic. All the mailed money and everything else that we stuffed everybody's bank account full of, they're spending that down. And that's true. That is some of that. But I also think that there's a comfort level about your job and your situation. People are not afraid to strike. We saw that with Hollywood. We saw that with UAW. They're not afraid to quit their jobs. We've seen the quit rates being very high. We've invented terms like quiet quitting if you're unhappy at your job, or labor hoarding if you're an employer and you're looking to try and not get rid of your decent employees before you let them all go. And you can always get them back, but now you can't necessarily get them back. So people start with this attitude that I have this weekly paycheck. Well, what happens if my job goes south and my boss fires me? Fine, I'll find another one. So we're still going to the Bahamas. And that seems to be, I think, the attitude that's come out of 2020. Maybe it's a PTSD from the lockdown restart or something else, but there's definitely a propensity to want to spend a little bit more, and a comfort level that the employment situation is much more favorable for employees over employers. That's why you've been seeing all these strikes over the last 6 months or so.
Can I poke at that a little bit?
Sure,
and my
poke
main
at it a lot.
Well, my main question is a lot of what you're talking about, to steal a word from the Fed, is that transitory, right? Is that part of the whole revenge opening up from COVID? We were locked down, and hey, I find I've got more bargaining power with my employer right now, and I'm still flush, from all the forbearance programs and stimulus and all that stuff. Because I can point to a lot of things right now that show that the direction of trend looks like a lot of that, for the consumer at least, is not as strong today as, say, it was a year ago. And let me just mention a couple of things. So we've definitely been labor hoarding, no doubt there. But I think it was the stat that came out 2 weeks ago or so, that like 40% of businesses are saying that business managers saying that they expect to do layoffs later this year. If you look at the quits rate, it's been coming down. The gains in wages that we've seen recently, they're beginning to moderate. So it seems like the pendulum is perhaps beginning to swing back towards the employer. It's not all the way over there yet, but it seems like it is. We've seen sort of peak employee bargaining power, and it's now beginning to head the other direction. We have the savings rate has gone down an awful lot. I'm sure Rosenberg talked about that in the roundtable you guys were on. We've seen revolving credit spike and spike at a time where APRs are at record highs. So people aren't happily spending on those credit cards. They're probably spending more because they have to, right? And even though we had a quote unquote good year in the markets in 2023, on a 2-year basis, the markets are pretty flat. Right. And I just saw this updated stat the other week, which is 10% of financial assets in the US are owned by, 93% of financial assets in the US are owned by the top 10% of households. So not a lot of people are looking at their statements and saying, oh, stocks went up this week, I feel wealthier, I'm going to go spend it, because almost all those stocks are held by only 10% of households who do a lot of spending, but still. And then the housing market, I don't know if folks are feeling like flush about their houses because the housing market's kind of been frozen. Yeah, it hasn't gone down that much nationally yet, but there's definitely more worry, I think, in the market than there was a year or two ago when prices were still jumping double digits year over year. So I just feel like, I can point to a lot of kind of cracks in there that say like, it's just not as confident as it was a year plus ago. Feel free to push back.
Yeah, so a couple of things on that. Let's start with the labor market. If you look at the data in the labor market, initial claims is still around 200,000, slightly above it. If you look at the last 50 years, that is usually associated with a boom when you see the claims numbers being that low. Payrolls are still continuing to crank out about 200-ish thousand jobs a month on a 3-month average. It 3-month average was coming down, but bottomed in the last 6 months or so. We only need, if you believe economists, about 75 to 100,000 jobs a month in order to capture population trends and graduation trends in the economy. So we're producing a lot more jobs than we have, and that's why the unemployment rate is still under 4%. As we sit here right now. The quits rate is coming down, but even the current November's the last quits rate number. It is lower than it was a year ago or 18 months ago, but it is higher than any number seen pre-pandemic. So we are just in a whole new realm of quits that we ever experienced before. So I think that there is this comfort about jobs in the market. And let me be more specific. Non-professional lower end jobs is really where they're viewed as being almost like commodities, like get this job, quit this job, go get another job. And that's where you're seeing the labor hoarding going on. We're not labor hoarding partners at law firms. We're labor hoarding, people that work the stock at big box retailers. That's who the labor hoarding is. Because once you get somebody who's been promoted a few times and is very good at what they do and very responsible, you don't want to let them go. And that's what the labor hoarding is, because you're afraid of what you're going to get in return, where that is a very different attitude. A couple of the other things that you mentioned, I'm in a mental block. What were some of the other things you mentioned? Because I had, on housing. Yeah, the housing market is frozen, but it's frozen in a unique kind of way. If you look at, say, the Redfin data or the Zillow data, the average home price is not really coming down that much, but sales are. What seems to be happening is people call a broker and they say, I want X for my house. And the broker says mortgage rates are up, so that means that monthly payments are more. You should consider lowering your price to compensate for higher mortgages. And these people are saying, nope, I want X. And if nobody shows up to look at it, that's fine, but I'm standing on my price. And that's why sales are going down, because we're not giving on those prices. Now, why aren't we giving on those prices? I think it's because we're not feeling stressed and impatient that we have to sell, that something has changed in my life, or that there's something, and I need this money. I need to get out of this liability of this home.
Let me just poke at that for 1 sec. Could be the case. Could the other case be, I'm going to be in a worse situation if I sell. If I don't get the price I want, mortgage rates are so high, I'm going to have to buy like a worse place with a higher mortgage. I don't want to do that.
Yes, that could very well be the case, which gets back to the original thing. I want my price. I'm not forced to acquiesce to higher interest rates by lowering my price. Now, the people that are lowering their price for that are new home builders. And actually new homes as a percentage of all homes sell, I think is at a record high or very close to a record high. Something like a third of all homes sold in America now are new homes, because the builders, well, they're in the business of moving inventory anyway. Got to cut that price, get this thing off the books so we could start the next project. So those homes are moving too. So I guess what I would say about the housing market is that if you would have told us, if we were sitting here 18 months ago and said, mortgage rates are going to 8%, what's housing going to look like? We would have said a hell of a lot worse than it actually is.
I would totally agree with you. Yep.
Yeah. Now, and I also want to emphasize what I said in the beginning here. When I say people are feeling comfortable and they're spending and they're not being as stressed, there is one thing that is stressing them, and that's inflation. And that is a big thing that is a big problem, but it is because the economy is showing that trend to above trend growth, that we keep spending to keep the inflation rate sticky. Look, there's two things about inflation that can be happening at the same time. One, there was a big transitory element of savings because of the of inflation, excuse me, because of the pandemic. That's why we went to 9%, and
Yeah,
we had
that's
all
the
those
cost
problems.
push. That's the supply chain shortages. Yep.
Right, right. All right, that happened and it's receded. But once that's receded, I think what we're finding is we're no longer in like a 1.5%, 2% inflation world. We're in a 3 to 4% inflation world once that thing has receded. Now, why does that matter? If I was to now turn to markets a little bit, because that's where I think it matters. If I said to you that the inflation rate's 3 to 4% and the economy can still churn out 2.5% or so, let's just round that off and call that 5 to 6% nominal growth. The midpoint of that is 5.5. That's what I've been advocating about where I think interest rates are ultimately going to go. Somewhere in 24, the 10-year yield goes above its 5.03% peak in October of last year to around 5.5, because that 3% inflation rate, 2.5% growth rate continues. That's your 5.5% nominal rate. So I know a lot of people are more equity oriented. They're not into this macro stuff. All right, so 2% inflation, 3% inflation. Who cares? Well, it's the difference between, say, 375 and 4% on the 10-year note and say 525 to 550 on the 10-year note. That's where it matters. And that's where I think it, is the concern is when I say that there's going to be this trend growth or above trend growth and it keeps inflation sticky, it's going to keep interest rates up there. And that's why I've been still bearish on bonds. And I know it hasn't worked since October or November 1st, but I still believe that the 40-year bull market in bonds ended in August of 2020. We're in a multi-year bear market in bonds. We can talk more about that later. There can be 2 or 3 year periods in there where you can have a big rally in bonds. But it is because the inflation story has turned and the economy is not quite as weak. It's more like the 70s where we just have a higher nominal growth. Not as high as the 70s. We're not going to have 12% nominal growth like we had in the 70s, 10 of which was inflation. But we're just going to have a higher nominal growth than we did the previous decade.
Okay, so thank you, and I do want to go more into your outlook on a multi-year bear market for bonds ahead of us and higher interest rates. But especially given your outlook on interest rates, I want to go back to my question of is this sort of relative confidence that you're talking about, in the consumer, well, just in the system, I guess, is it transitory? And where I'm going with this is, there's the lag effect, right? And there's been a lot of debate on whether the lag effect is really going to manifest here, or if there are things that have happened this time around that have made the lag effect less relevant. But especially if interest rates continue to go up, we have, even at current rates, we have this concern about a maturity wall coming up for a lot of U.S. corporations as the debt on their balance sheet matures and they've got to refinance at these higher rates, right? And that could, if it does happen, that if rates don't come down in time, that really could injure the labor hoarding that you're talking about, right? Where they're like, we were holding on to these people for as long as we could, but Jesus, now that we got to re-rate, we got to start, bringing prices down or costs down, and we got to start chopping off limbs. And secondly, on households, you have that as well, where I mentioned earlier the record amounts of revolving debt that households are taking on, but also to your point about inflation. As long as inflation remains elevated, it's a squeeze on these households. Like how long can they spend more than they were spending before and save less? Like, doesn't that have sort of a terminal date on it as well?
Yeah. So to the first part of your question, yeah, could this be transitory? Of course it could be. And what would be, in my mind, the sign that it would be transitory? It would be some indication that remote work is ending, because that's the ultimate indication of employee power. I don't want to come to the office 5 days a week. I'll come 3, but I'm not going to come 5. So I'm going to say work from home on Mondays and Fridays. If we could push back on that and get people back into the office 5 days a week, that would be a sign that, it was a little bit more transitory. Go back and look at this past Sunday's 60 Minutes. They did a whole segment about the evolving nature of the office market, the office tower in big cities, converting them to residents, and about how they talked to some of the biggest commercial real estate owners in Manhattan, and they're just acknowledging they are not coming back. They are not coming back 5 days a week, and so companies don't need as much space. And there's like 90 million square feet of vacant vacant offices in Manhattan, and that's not going to change. And they're trying to repurpose these buildings to the point where they're even trying to reimagine what a city is. And cities will reimagine themselves. So if you saw that trend break and people started heading back to the office, but it's been 3 years, and even the real estate guys are giving up on the idea that we're going back to the office. So, but if that does happen, that would be the signal. The other thing to keep in mind too about rising interest rates, you'd mentioned a statistic that 90+% of all assets are owned by the top 10% in income. Now, a lot of those assets that they own are fixed income assets. And so what they're doing is they're getting interest income.
Yep.
And what you're finding is among the top 10, as you are finding with companies, as interest rates have gone up, their financial position has improved.
It's getting better. Yeah, it's a stimulus to the top of the pyramid. Yeah.
Right, because they're getting more in interest income. Warren Buffett has $120 billion of cash. Berkshire's going to get $8 billion more of revenue this year than 2 years ago, simply because his cash went from 0 interest rate to 5%.
Right. For free and no risk. Yeah, exactly.
Right. Microsoft is the same way. So their positions are improving. Now that I've said that, when interest rates go up and the markets recover, the top 10% feel better because they're getting more interest income, and they're seeing at least they've recovered their 22 losses. Now let's turn to the depressing part of this equation. That number you gave me comes from the survey of consumer finances by the Federal Reserve. They look at the liability side. The bottom 50% of the country has 56% of the debt.
Right.
So the rich people have all the assets, and the poor people have all the debt. And I'm sorry, but that's the way it is. So and no other than Jay Powell understands this. This was his mantra in 2022 of why we have to get inflation down, because these people that live paycheck to paycheck are not only seeing inflation move up faster than their paycheck, so their relative purchasing loses, it's keeping interest rates up. And they're having to pay higher financing costs or consumer loans or credit card balances or whatever they have. And we have to get inflation down. And that was the mantra that we were saying in 2022. The joke was, be a patriot, lose money with dignity in the stock market to kill demand so that inflation could come down. Well, that's out the door now. We're done with that now. We want the Fed to cut rates. We want everything to go up. But we haven't, I don't think, quite solved that inflation problem. And that's going to affect the bottom 50%. And that's what you see in the president's approval rating, why everybody's so angry and his approval rating is down, and they keep citing inflation as being the biggest reason that they're angry, is because it's those bottom 50% that are seeing it. You and me and everybody else, we just grouse about it, but we have the ability to pay those higher prices.
Okay, so great point, and I really want to dig into this. First off, though, I just say I don't think it's the bottom 50%. I think it's the bottom 80+%. When you look at the wealth distribution, it really is. You're either in the top echelon or you're hurting with the vast majority of the rest of society. So okay, so back in the intro, I talked about is QT ending, right? And this past 48 hours, we've seen a lot of buzz, Nick Timrose, the Fed mouthpiece, and then JP Morgan issued a note very similarly saying that for all these reasons, it's highly likely that the Fed is going to implement the first rate cut by April, if not sooner. And who knows? We can debate that, or anybody can debate that. But my point is to your point, they haven't really put the wooden stake in the heart of inflation and confirmed that the undead corpse is truly done. Is this a little surprisingly premature to be pivoting to not just rate cuts, but also ending QT this quickly?
Well, I understand why they're trying to end QT, and they're getting a little bit concerned about what's about to come. So let me try and step us through this here real quick. When the Fed was doing QE, quantitative easing, there was too much money in the system, and they were afraid that that was going to keep interest rates forever at zero. So they instituted a plan to sop up that extra money, which is known as the New York Fed's reverse repo facility. If you've got extra money if you've got extra money in the system, you can then go place it at the New York Fed, and they will pay you an interest rate, which is tied to the funds rate, 20 basis points below the top end of the funds rate. So they're currently paying you around 5.3% on that money right now.
Right. And sorry, just to underscore for folks, the reverse repo program is a form of tightening.
Yes, it is a form of tightening because, and who does it, by the way, is usually your money market fund does it. Like earlier this year or within the last year, something like 40% of all money market fund assets were at the New York Fed in this reverse repo facility. But when a money market fund takes their money and says, we're not going to buy a T-bill or commercial paper or something, we're going to place it at the Fed, and the Fed's going to pay us an interest rate, which passes along to you, and it's one of the safest instruments in the world. So there's nothing to be concerned about that they're doing it. What they're doing effectively is by taking money and putting it at the Fed, you're removing it from the financial system. You're taking liquidity out of the financial system and you're parking it at the Fed. That money still exists. It just exists outside the financial system at the Fed. The Fed's kind of separate of the financial system. Well, as we've gotten into this period now where the Fed has stopped raising rates and the Fed is now talking about lowering rates, money market funds are looking at, remember, money market funds have to manage or advertise on yield. And they're saying, look, I give 5.3% with the Fed not every day. It's a one-day overnight loan, and I just renew it every day is what I wind up doing. But at some point, the Fed's going to start cutting rates, and that number is going to come down. Maybe what I should do is buy a 6-month or 9-month Treasury bill that's yielding somewhere near that, somewhere around 5.2, 5.3. So when the Fed starts cutting rates, I still have that high rate locked in for many more months, and my average yield stays up and attracts money to my fund, because that's how you do it for money market funds. You advertise on having a higher yield than your competitors. So money has been coming out of the New York Fed system, and it's been going into long-term Treasury bills. That means that money is re-entering the financial system. That is a form of liquidity coming back into the system. And it's also allowed the Fed to do or the Treasury to do something else. Back in November, when we had the quarterly refunding announcement, this is the refunding announcement that we get from the Treasury that says how many notes and bonds and how many bills are they going to issue in the upcoming quarter. Janet Yellen, the Treasury Secretary, surprised us by saying, we're going to issue less 10-year notes and 30-year bonds and 5-year notes, and we're going to issue more Treasury bills. And the bond market loved it. Oh, less supply for bonds. And they took off and rallied, and those rates plummeted. And the bill market was fine with it because all this money was leaving the Fed's reverse repo facility, coming back into the system, and was sopping up all these extra bills. Well, now we're at the point where almost all that money that was in the Fed's reverse repo facility has now re-entered. There's not that much left. There used to be 2.2 trillion in that system. It's down to about 600 billion right now. I don't think it has to go all the way to zero. I think there will always be some residual in there. But at the rate it's going, it's probably a month or two away from being out. And that's going to be a problem. So the Treasury is going to have to look and say, look, we can't keep issuing bills at this rate because we don't have this excess money coming in to buy them. We might have to shift out and issue more notes and bonds, which is why the bond market yield, the 10-year yield kind of stopped going down around 4% over the last month. It's had some brief interludes below 4%, but it kind of waffles around that. So this is the concern, is that when the reverse repo facility is done, all we're going to be left with then is the Fed doing QE, pulling liquidity out of the system.
QT.
And we're seeing, QT, excuse me, pulling liquidity out of the system. And this is the concern that the plumbing of the financial system has. We're going to have a liquidity problem. The Fed understands this. And it seems like, even last week, I thought they weren't going to do anything about it, but it seems like they're going to start tapering the QT. It's $95 billion a month that they reduce their balance sheet. Maybe they go to 85, then 75, then 65 every month, or some version of that on their way to zero, because they don't want to be sucking out so much liquidity. What do we know about liquidity? The financial system works on these overnight loans, and that you can get these overnight loans at the prevailing market rate. That instead of forcing banks and brokers and hedge funds to have to sell securities to meet obligations like more margins and performance loans for derivatives and stuff, they could pledge these securities and get a loan at prevailing market rates to do it. But if all of a sudden there's not enough liquidity and these loans become much higher interest rates than market rates, that could create a lot of problem, because the plumbing of the financial system runs on a highly levered basis. And if you wind up having them to pay huge premiums, you could wind up with a lot of problems in the financial system. So the Fed is worried about that. So they're going to try and not be as big a drain on the financial system. So hopefully I explained that. And this is why I think that the QT program is going to start to probably get reduced. And we're probably going to see more bills. But the last thing I will say to you about this program, I explained it. Maybe you still followed me on my explanation. And I could tell you that the people that are deep up to their elbows in this stuff will tell you that it is so complicated, no one really understands it. And that one of the reasons why the Fed might be willing to back off on QT is they are afraid that if we wait, if we're not serious about this, that some unintended consequence will come on and wreak havoc in the financial market, like the repo crisis of September 2019, when these overnight loans went to 9% and had the potential to cause a lot of problems. So one of the reasons why they're paving the way to do this is precisely because it is very complicated and it is not straightforward to really understand it.
Okay, thank you for doing all that. And let me just condense this for a second, because I think you've connected some dots that I think people have wanted connected for a while. So the reverse repo program, as we mentioned a few minutes ago, is tightening. But when you unwind the reverse repo program, as has been going on of late, that is a form of easing, or it's injecting liquidity into the system. And so what that has done is it has really cushioned, maybe some could even argue negated, the impact of QT and a lot of the bite from the rate cuts, right? Rate hikes, right? So what's been interesting is we've been sold that we've been in this era of tightening, but a lot of the things that we would have expected to see reflected in the markets and the economy haven't, and it's because this flood out of the reverse repo program has basically been offsetting the tightening and the hiking, right? So I think that's hopefully an important light bulb to turn off in people's brains.
That's exactly right. And if you get that, you're way ahead of the game on most people. Yes.
Okay.
And the next part is that it's almost done. We're almost out of money.
That flow of funds from the reverse repo program is almost done. When it's done, then we really start to feel the bite of QT in full, right? It's no longer being cushioned. We feel it in full. And you're saying, well, that could end up creating a liquidity crisis, which is something that the Fed, lays awake at night about, because their job is to keep the banking system, operating. And the liquidity crisis is one of the things that threatens it to seize up, right? So this now goes back to December, when Powell got up there and kind of surprised everybody by being a lot more dovish than they expected. And one of the questions that, what was asked at the time was, all right, does he really believe what he's telling us? Which is, hey, we got to start, we can't start cutting rates when we get to 2%. Because of momentum and whatnot, we'll end up going lower than we want to on inflation. We got to start cutting before we get there. We think now is the time to start cutting, right? It's the whole like gentle landing, soft landing, story.
Yep.
But other people were like, oh, is that really the case? Or is he worried about something that he's not telling us about? Right. And I think what you're saying is that might have been the case. And this might have been the thing that he was really worried about. Right. So
Right.
what's interesting, and to your point about how complicated it is, I lie awake worrying a lot about that, which is a lot of our systems are so complicated. I know that the people running them know that they fully don't understand them. And you do worry that like if we let something get out of control, maybe it becomes something that none of us can contain at the end of the day. Maybe that's his worry. But let me ask you this. So Powell has said for the past 2 years, when asked about his commitment to higher for longer, was he said, yeah, I don't really mind if I tighten too much because I've got the tools to fix that, right? If we start falling into recession or there's something, going, some crisis, something quote unquote starts breaking, I've got the monetary duct tape to come in and fix that with programs like the BFTP. And, I can change interest rates on a dime and I know how to do that stuff. It's inflation running away from us. That is the bigger fear of ours. And I don't want to be Arthur Burns and we're going to make sure we kill inflation. So he all of a sudden seems to be like pivoting on that, right? Like, well, now I'm a little bit worried about this liquidity crisis, so maybe I'll let inflation run a little hot now, right?
Right. And that's exactly it, because you're right. December 1st, Powell said it was premature to talk about easing. And then December 14th, which was his press conference, they came out with the new dot chart and he explained that now we're going to cut rates 3 times, to which everybody said, what happened between December 1st and December 14th? And if you go back and you look at the data, nothing happened, except you practically did a 180 in 2 weeks off of like no data. And so a lot of people are looking at this liquidity thing as being a potential concern. By the way, a quick word about that. And this is where I really have my criticism with the Fed. There's nothing wrong with having complicated systems in life that, we don't fully understand, but we do our best, but we come into it knowing that it's beyond us. The most successful generals in the world know that when they put together a battle plan, and that only works until they meet the enemy. And then it becomes a complicated, chaotic system that they have to adapt to. The problem I have with the Fed and some of the other monetary authorities is, oh, no, we know it to the 4th decimal place. And we have these knobs and levers that we could turn and pull. And we could, what inflation rate do you want? I could just turn this knob over here and give it to your, or what liquidity level do you want? I'll just turn that knob over there. And they give this conceit that they know how to handle this stuff to a degree of precision that they can't. If they would just kind of attack it like the generals do and say, here's my plan, but as soon as it meets the enemy, we'll see if it still holds up. And we might have to just throw it out and go with something different. We'd be much better off, because we would approach this with a bigger respect than a conceit that we've got it all figured out and that there's no problems here with it. And so I think that as the Fed is probably trying to communicate that it doesn't have that conceit, but at the same time, they're trying to say that they have that conceit. And that's why we're all kind of left with a head scratcher. Why did he change? And should we be concerned and stuff? We shouldn't necessarily be concerned about this liquidity thing if we approached it in the right fashion. But if we approach it in the fashion of that the Fed has this magic knob, which is, QT, tapering QT, problem fixed, you could ignore it, move on. Let's talk about AI stocks. You could ignore this. That's when you get into trouble.
Well, and you tell me, what's their track record of surgical precision?
Terrible. And I would actually use another word, but maybe we're a family show.
Okay. Yeah. So it's just, it's ridiculous for them to project and pretend it. And it's ridiculous of any of us to give them any credibility about it, just looking at their track record. Right.
Right.
Well, let me ask you this then. Trying to remember what you said about inflation. I know that you think there's a chance it could go higher from here. Going back to your very beginning, I kind of got the vibe that you thought inflation might go a bit higher here, but you're not super worried about it. But are you worried at all that this potentially premature pivot, could get inflation to back to uncomfortable levels?
Yes. And not only that, But the whole idea that we're going to pivot, we're going to cut rates, and we're going to back off a QT, and that is going to stimulate the economy, is premised on this idea that we are in the last mile to 2% on inflation, and it is no longer going to be a problem. And as Powell said, as you pointed out, we could get started on getting, rates back down and getting rid of QT now because we're going to go to 2. Well, what if we don't? What if we bottom out here? And like I said, 3 to 4. I'm not talking about 8 to 10 Zimbabwe levels of inflation, but 3 to 4. If we wind up doing that, it frustrates this whole plan that they have of trying to rein in interest rates, rein in liquidity, because one of the problems is if they start backing off the QT because they're afraid of taking liquidity out, and the market concludes, wait a minute, you're just trying to foster more inflation by doing that, it winds up backfiring on them. It's kind of analogous to another thing that's going on. As of Friday, the market had priced in 7 rate cuts. Now, there's only 8 meetings a year. And the January meeting, there's got like a 4% chance they're going to cut rates. So that must mean that every meeting this year, the market expects the Fed to cut rates in an election year. And people say, yes, because it's an election year. And yes, Powell remembers all the mean tweets and he doesn't want that guy back. So he's going to cut rates to try and help the other guy become president. That's the cynical argument. But I've always said, yeah, hold on a minute. He could cut rates to help the other guy, but if he cuts rates and we have inflation, it blows up in his face and he makes it worse. Instead of making it worse for Biden to get reelected, not better for Biden to get reelected by lowering rates if you do it in the face of sticky inflation. So really the whole thing comes down to this inflation argument and whether or not inflation will give them the maneuverability to be able to back off on the QT and to cut rates as much as they would like to.
Okay, so many questions packed into this. I mean, one is the market just smoking crack here, right? I mean, is there a scenario where the Fed could cut 7 times in 2024 other than, oh my God, we've broken something, the economy's falling into a recessionary vortex and we got to get rates down like ASAP, right? I mean, I can't imagine any other scenario than that where the Fed could really justify this. And I think if it tried to do what you just said, which is, oh, we'll just do 25 basis points for the next 7 Fed meetings, inflation's going to go crazy.
Right. Well, to answer your question, first of all, is the market always smokes crack, I guess, to stick with your mouth. Because if you look at the history of whatever the market prices in, it's always wrong. It never comes to pass. So, Deutsche Bank did this study about a month or 2 ago where they looked at like the narrative in the market and the pricing in the market. And they announced that what we're seeing now is the 7th pivot towards lower rates in the last 2 years. The first 6 didn't work. The Fed kept raising rates. Well, maybe the 7th time is the charm, but that's the point, is that the market constantly gets this, stuff wrong. To your other point, you're right. What would cause them to cut rates aggressively? The same thing that caused them to cut rates aggressively in 2020 and 2008. Those were election years too. A perception that the world was falling apart, either because of the lockdowns of COVID or the financial crisis in 2008. They were as aggressive as they ever have been in their history because they were forced to, because things were going bad in those election years. So there is this argument, and I'm a subscriber to it, that 7 rate cuts or 6 rate cuts, whatever you think is priced in, is kind of an expected number. And what that means is that there's probably a 75% chance the Fed cuts 3 times. And there's a 25% chance the Fed cuts 10 or 12 times. That's your bad recession. And when you do an expected number of those, you come up with 6 or 7.
But the weighted number is 6 or 7, yeah.
Right. But we're not going to get 6 or 7. We're either going to get 2 or 3, or we're going to get 10. We're not going to get but the midpoint is what we're looking at, thinking that that's what's going to come. So there could be some of that going on, which is why the market does a lot of that weighted average stuff, which is why it looks wrong all the time. Because, you know, it might actually, if you actually dissected it, be a little bit more right that 70% or 60% chance did happen. It's just that the other 40% was in that weighted average that made it look like it was too aggressive.
It may be, although I've not really heard that many people come on the airwaves and say, oh yeah, I'm expecting, 12 rate cuts this year because I think we're going to fall into a massive crisis. So if there's a percentage of the market that is planning for that, they're being pretty silent about it, at least, on the airwaves.
You wait until we get a bad number. Look, we just beat on CPI, we just beat on payrolls. We still have 200,000 on claims. One of those numbers comes in shockingly weak, you'll hear that.
I
But
guess
that's
so.
why
Although I
you're not
will
hearing
say
it
I
now.
have a number of the people that come, I get slammed all the time for, being bears on parade on this channel. And I'm not. It's just the people I bring on are data driven, and they report how they feel given the market environment. But none of them, to my knowledge, has said, I expect, 10 this year. But who knows? We'll see. But let me get to the other part of this, which is, all right, well, let's say it's the Fed's, let's say it plays out as the Fed says, right? They cut 3 times this year. I think, and I don't want to put words in your mouth, but I think that still worries you from the inflation side. Like even that alone, could create an Arthur Burns uptick in inflation.
It does, unless my scenario on inflation is wrong, and we are really truly on the path to 2%. And then otherwise, I do worry that you will create those animal spirits. You will give the stock market a reason to go up. You will give the 10% that own 90% of the assets and do the vast majority of spending too, because they're the people with the money, reasons to book that trip or spend that money and to push prices higher. And you've got other things out there too that are really worrisome. Let me give you one that is just coming into focus, in the last 10 days or so as we're starting to talk, which I've been focusing a lot on. And this is what's happening in the Red Sea.
Yeah.
And I'll just sum it up real simple. The Red Sea shipping lane is one of the most trafficked shipping lanes in the world. About 12% of all shipping traffic goes through it, goes through the Suez Canal into the Mediterranean. About 30% of containers that have all the finished goods that we get from Asia go through the Suez Canal and the Red Sea.
And a lot of oil does too.
Yeah, and a lot of oil does. Currently, the Houthis are attacking cargo ships. So the cargo ships are being reverted around the Horn of Africa, and that's adding 3,300 miles and 10 extra days to the travel. Oil tankers were still allowed through. They weren't attacking oil tankers, but even them, they're starting to divert around too. We live in a just-in-time world, is what we live in. And the example I gave is, I might be somebody that needs semiconductors from Taiwan to put into a navigation system, to send to a dashboard assembler, to send to a car manufacturer, so they could finish the car to send to the dealer, who could send it to a customer. And maybe that car's a truck, and that customer needs that truck to make deliveries of his product. And once that daisy chain starts getting mucked up at the beginning, I don't get my chips, I can't make my navigation systems, you can't finish the dashboard, they can't finish the car, it can't get delivered, the customer can't get it. If he needs it for deliveries for himself, he can't make his deliveries. The whole system becomes really messed up. Is it as messed up as it was in 2020? Probably not, because
Probably not, but it's echoes. Yeah.
Right. You're right. Because we also had a demand thing too. We had the revenge spending. We were mailing people money at the same time we had that going on. And so that could produce goods inflation, because we're starting to see container ship prices, the price to ship a container go up because of the lengthening demand. But what's basically happening is, most container ships are like they run like a circuit, right? They go back and forth 6 times a year between Asia and, say, Europe. But now that they got to go around Africa, they can only go back and forth 4 or 5 times. Now we need extra ships to accomplish the same thing. And that's putting a tightness back into the market, which is why the price to ship a container is going up. And the reason we're paying to extra prices to ship containers instead of cutting back on production is because people want that stuff. They're willing to spend to get that stuff. So that's another concern that I see as far as this Red Sea thing goes. And if you do the same thing with oil tankers, it's the same thing that happens too with oil tankers. They take a longer trip. You need more oil tankers to accomplish the same thing because they take a longer trip. The difference with oil tankers is there is an abundance of extra container ships. There isn't much of an abundance of extra oil tankers in the world.
Right.
And
Or
we could
crew.
hit for crude, we could hit a
No,
limit.
or crew, people to actually run them too.
Or crew, yes, that we could actually hit a limit. We want this much crude oil. Well, yeah, when I used to go through the Suez, I could turn my tanker around and get back, to the Persian Gulf to refill to bring that oil back the other way. Last thought for you. This is a Europe problem because it's Asia to Europe. 35% of the goods that come to American East Coast ports, New York, Charleston, Savannah, come through Europe. So that's a third of them. The other 2/3 come through the Panama Canal, and there's a low water level on the Panama Canal, and it's only running at around 2/3 or 3/4 of its capacity as well too. Supply chain is being stressed again. I don't think it's being stressed to the extent that it was in 2020. So we're not going to have as big a problem as we were in 2020. But if I'm looking at sticky inflation and I'm looking at a world where the Fed is going to do some backing off of QT and cutting rates and stimulate and telling everybody keep buying, and now it's a little bit harder to get those products, you're going to see higher prices across the board, and you're going to see the bond market, I think, react poorly to that.
Right. And the timing isn't good, right, as the Fed is maybe going back towards easing. And these issues are ones that, are cost push inflationary that the Fed can't do anything about, right? It's not a monetary issue. No amount of stimulus is going to get more shipping containers through the Red Sea right now.
But stimulus can keep demand so that people would say, what's available and how much do I have to pay to get it, which is paying more for the same thing, which shows up in the CPI and the PCE report is higher inflation.
Right, exactly. I mean, my point is they can't, yeah. So, I mean, it's coming at a bad time. It's something the Fed can't control, and the levers they normally pull will only potentially be additionally inflationary here. All right, look, I got so many other questions we haven't gotten to. I might do a speed round on one or two of them, but real quick, let's get to the meat of the issue. So, given your outlook here, which basically says, if I got this right, economy looking like it's going to kind of chug along for the foreseeable future. We got these inflation concerns you've talked about. The cost of debt is probably going to, I think you see it going up from here, not crazy high, but higher than probably the market expects on average right now. I think you said 10-year back to 5.5 or so.
Yep.
With these other sort of burgeoning risks that we talked about here, they could dial up, they could dial down. We don't know for sure. How are you thinking that, investors should be considering navigating this in 2024? Like, basically, what's your market outlook, and what assets do you think are well suited for this environment, and which ones might not be?
So I'll start with the fixed income market. And I'll make a shameless plug that this is exactly what I'm doing with my discretionary index, the Bianco Research Total Return Index. And there is an ETF that tracks at WTBN run by Wisdom Tree. So what I'm explaining to you is exactly how I've got it set up. I think that interest rates could go up. I think one of the lines that people like to use is that, the Fed raises rates and rates go up until something breaks. And over the last 2 years, I've been on with you over the last 2 years. Was it the 25% correction in the stock market? Was it the big sell-off in the bond market? Was it the banking crisis of last March? All of those at one point looked like, yeah, that could have been the thing that broke. But here's we sit in January of 24 and we're like, no, that really wasn't. So one of the arguments I'm coming with is, while rates are up, and it is a drag on housing, it isn't catastrophic for housing. It is a drag on borrowers. It isn't catastrophic on borrowers, that the economy can handle these higher rates. I think the mistake we've made is we got so used to zero between 2010 and 2020 in the QE period that we anchored ourselves to that. We look at these rates and we go, man, these rates look punishingly high. And I was like, but if you compare them to pre-2009, they're not unusual rates. and the economy was just fine in the pre-2009 era. It was able to handle those level of rates. So I think rates are going to go higher. What does that mean for equities? Equities is an interesting case because throughout all of 2023 until end of October, they struggled, except for the Magnificent Seven. At the end of October of 2023, the S&P was up 7% for the year. But if you took the Magnificent Seven stocks out, the S&P 493 was down on the year at the end.
It was
of
negative,
Halloween. Yeah, it was negative around Halloween, as was mid-cap stocks, as was small-cap stocks. But the earnings numbers were okay. The economy was okay. We had 4.9% growth in the third quarter GDP. That's a booming number. What caused the stock market to struggle so much, other than the 7 AI stocks? The competition of rates. Dr. Jeremy Siegel wrote an update to his book, Stocks for the Long Run. In it, he says, what's the long-term potential for the stock market? It's 8%. If you bought stocks and you did the Buffett thing, let's check where they are in 10 years. You should reasonably expect an 8% return. Well, in 2019, if you were expecting an 8% return, your alternative was a zero in a money market fund. So we coined the phrase TINA. There was no alternative. But in 2024, your alternative is 5.3% or 5.2% in a money market. That's 2/3 to 3/4 of what you would expect for the stock market. That's why $1.5 trillion went into money market funds correctly, rationally, because it's giving you most of what the market would offer you without as much market risk. So if rates go up, yeah, you might get good earnings reports. You might get good GDP reports. You might get indications that the labor market's holding together. But the stock market's going to be bothered by the competition. I'm getting most of what you're going to give me in the stock market without the risk. I'm fine where I'm at right now. I don't need to extend out that much further like I did in 2019. I didn't want to get 0, but now that I could get 5, and you're telling me 8 is remember, the stock market's return, it has been 0, over the last 2 years, down 22, up 23. So I think what people are looking at is that competition for higher rates. So from my perspective, I don't think credit is going to be, is going to have a problem, which is why I'd be neutrally weighted on credit. I think stocks are going to struggle, and I use that word carefully, struggle. I don't think it's going to be a terrible bear market. But if you're expecting a levitation of the entire, index complex to go up, I don't think it can if I'm right and rates go higher. I think structured products like mortgages and stuff like that, they suffer because of the uncertainty and the higher volatility that we've seen in the marketplace as well too, that they wind up suffering there. And the yield curve will probably stay roughly where it is right now. I don't think it's going to uninvert, and I'm more speaking the 10-year 3-month curve, which is still around 100 minus 130 basis points. That historically, when does the curve uninvert? When the Fed panics that the economy is going down and they cut rates like crazy and short rates plummet through long rates. That's usually how you uninvert the curve. I just don't see them ready to panic just yet with the economy. So sum it up, that's how I've got my index structured. Those are my thoughts. Another shameless plug, there is a website, biancoadvisors.com, that explains our index and explains our thinking out there too as well. So that's how I would be structured for, expecting higher rates, expecting it to be a struggle, because I think that the inflation rate's going to stay sticky. Now, if I'm wrong on the inflation rate, I'm going to have to adjust all that other stuff. But right now, I don't think I am. And now that I look at what's happening in the Red Sea, I've got even more support for this idea that we're going to see stickier inflation.
Okay, so when I edit this, Jim, I'll put up the link to your ticker. I'll put up the link to biancoadvisors.com so folks know exactly where to go. Folks, the links will be in the description too. All right, I took notes here. Maybe I took them poorly because you're not that optimistic on bonds because you expect yields to go higher. You're not that optimistic on stocks because you expect them to struggle. So what is in the ETF right now? Like what are you taking short positions, or what are you long against? I assume there's some inflation protection in there. Maybe you like T-bills because yields are going to be high. Like what's in there?
So let me back up and say that there is one benefit that the bond market has right now, and it's best summarized by my friend Jim Grant, who runs the newsletter Grant's Interest Rate Observer, when he says it's nice to have an interest rate to observe again. And so, there's a
So great.
we had the big sell-off in the bond market and the huge total return losses because we had no yield. You had no cushion. Now you have a 4.7% cushion in the bond market. That's the average yield of, say, the broad investment grade indexes, around 4.7%. That yield should cushion you to a positive total return for the year in all of the indexes. So the bond market, yeah, I think that the price could go down if you manage that price properly. Our index is a long only index. We're always in the market. We're underweight certain things like duration, shorter maturities, in order to protect ourselves from falling bond prices or higher yields. We're underweight mortgages because of the higher volatility. We're equal weighted in corporates relative to a benchmark. So, we're just doing it relative to a benchmark because we still want to grab that 4% yield. We want to protect that 4% yield. And then maybe later this year, look for an opportunity to get some capital gains by buying something when the price goes up to augment that 4.7% yield as well. So we're not short or anything else. And you're right, we do have a 20% weighting in our index in short tips. What I mean by short tips is 0 to 5 year maturity tips, not shorting tips. And so that, because they're not as sensitive to the interest rates movements, but if the inflation rate goes up, and a tip security, so everybody knows, pays you two things. It pays you a real rate of around 1.6%, and it pays you the inflation rate. So if the inflation rate stays at around 3, we will get that 3% or 3.5% inflation rate if we're right, plus another 1.6%
Plus the real rate.
on top of that. Plus the real rate. So that's what we are invested in right now. And it's all premised on this idea about inflation. Now, if the inflation story falls apart for whatever reason, like, again, I don't think it will, we will adjust it accordingly. And the last thing I'll mention is in fixed income land, it's a little bit different from equity land. In equities, when you ever say, look, I'm structured long only to beat an index, people correctly roll their eyes and go, 95% of managers can't beat the S&P. And that's historically been true. It's been very difficult to beat the S&P. It's always at the top of the heap, which is why index funds are so popular. But in fixed income land, if you look at some of the broad fixed income indices like the Bloomberg Aggregate or the JP Morgan Broad Investment Grade or the ICE Domestic Master, these are just the big, broad kind of S&P versions in the bond market. Typically, among active managers and people that run discretionary indexes like us, that those indices fall in about the 50th percentile, somewhere in the middle. So being able to outperform in fixed income land is a little bit easier because the index isn't this tower of power. There's a lot of reasons why, but the biggest one in equities, your Magnificent Seven are your biggest winners. They're usually overvalued stocks, and you have to be in them all the way, otherwise you fall behind the index. In fixed income land, so your all-stars in equities are your biggest, weightings. In fixed income land, your biggest weightings are your problem children, your over-levered companies, your over-levered countries like Italy or Japan. And they're one slip on the banana peel away from disaster. And you see it, you avoid it. And since they're such big weightings, you can beat the index in fixed income land. And that's why the index falls in the 50th percentile in fixed income land, where it falls in the 95th percentile in equity land. So it's a very different game in the bond market than it is than the stock market, one trying to measure yourself against an index.
All right. Very helpful, very interesting too. All right. Well, look, in wrapping up here, there's so many great topics I wanted to get into with you. So obviously we're going to have to be back on again soon. If we can we just do lightning round on a couple of them?
Yes,
And
I'll keep it to 2-word or 3-word answers.
All right. I feel bad because some of these require like an interview in themselves. All right, so you've got some concerns about inflation. So first, let me just ask about gold. Any thoughts on gold right now in the environment you see ahead?
Should be doing better, but it is suffering under the weight of all of the degenerate gamblers piling into Bitcoin ETFs and avoiding gold. That'd be my
Okay,
short answer.
that
It
was my
is at an
next.
all-time high. It is at an all-time high, but I think it should be doing a lot better than that.
So I've had you know, some people of late on this program say they think that this is going to be gold's breakout year finally, right? Starting from a very high level, lots of great, sort of fundamental reasons behind it. The dollar has been strong, maybe we'll go into a weakening phase, and that this could be the year that it really kind of cracks above long-term resistance and goes off to the races. What kind of probability do you give that? High, low, or medium?
Medium. And the only reason I give it medium is, look, I want to be a gold bug. But I remember 2020 and 2021. You shut down the economy. You unemployed 14 million people. You produced 9% inflation. You produced a giant deficit. People were worried about the collapse of the financial system. And you couldn't get gold to go if you electrocuted it at that point.
Yeah.
And so I look at that with profound disappointment and go, man, if that couldn't get it to 2,500 or 3,000, maybe there are some things that can get it to go to 2,500 or 3,000 right now. Look, I'm not necessarily bearish on gold, but to have that spectacular breakout year, I just don't see it. And the last thing I'll say real quick about gold.
Yeah.
One of the problems with gold is that was the traditional way you get your money out of the financial system. You're worried about the financial system. What do? You buy gold. It's the closest thing you could do. But what we've done over the last decade or maybe generation is we've sucked gold into the financial system. We put ETFs on it, futures, options, derivatives. Gold miner
Get shoved
shares.
around. Yeah.
Right. So what gold becomes is another fiat currency. So if you think that gold is going to really break out and go, that means the dollar is going to go down. You accomplish the same thing by buying the euro or the yen, because they're going to go up for the same reason that gold is going to go up, because the dollar is going down. That's the problem, is that it's kind of become part of the system when its allure used to be it wasn't part of the system.
Got it.
Bitcoin's got the same problem with the ETF. They're going
Well,
down that same road.
That's where I'm going. Just real quick, though, just to underscore, gold was the anti-financial solution, and you're saying it's become much more
Yeah,
financialized, right?
right. Exactly. It's become part of the problem, not part of the solution.
Okay. So spot Bitcoin ETF just got approved. How material an event is that? What implications, if any, do you expect that to have for the Bitcoin and crypto world in general?
Very material. It was one of the more hyped ETFs that we've ever seen, so much so that they started a fee cutting war on these ETFs before they even started trading. I mean, that's how hyped it was. And some of these ETFs got down to a zero fee. Short term, I think that this is the textbook definition of, buy the news and sell the rumor. So it's gonna struggle from here. Longer term, what I fear is the same thing with gold. What did I like about, I'm a bull on cryptocurrencies long term. Why? Because I think that they're building an alternative financial system. It's not there, but they're working on it. And I've got hope and promise that they're going to find a better alternative financial system, especially for people in Latin America, Asia, and Africa that have lousy financial systems, have terrible currencies, have no way to store their net worth.
Or unbanked, yeah.
Yeah, or unbanked. That's the word I was looking for, as well. But what I'm afraid of with the ETF is, by roping you into the system, all of a sudden, all that innovation and all that push to try and create an alternative financial position is just going to go by the wayside, and everybody's going to want to just put their money in red or black and just kind of just speculate on whether number go up or number go down, and kind of lose the plot of what they're trying to do. I hope I'm wrong on that, but I just see them so mesmerized by this ETF, and it's just consuming all of their energy. I'm like, aren't you guys supposed to be building the next financial system instead of just doing your technical analysis, speculating on when Bitcoin's going to get to 60,000 or not get to 60,000? We're like I said, we're losing the plot. That's what I fear, and I hope I'm wrong on that. But right now, I think that we're probably going to have a sell the news type of period, and then some indigestion, and then we'll see if my fears are overstated and that they actually are getting back to developing that new financial system. of which Bitcoin would be the cornerstone of it. And then, I could go back to being that long-term bull again.
All right, and I'm going to ask a very naive question about this. Do these ETFs, do they own underlying Bitcoin, and is it just all the net asset value of Bitcoin holdings, or is this like paper Bitcoin, right? Where
No.
just like GLD has a lot of gold futures in there, so there's it's not fully allocated to ounces of gold.
So there was a series in 2017 of Bitcoin futures that the ETFs own the futures contracts that trade on the CME on Bitcoin. And so that's a BITO is the big one there. That's a separate product. This one, they own the actual coins themselves. One of the reasons why Coinbase's stock has gone ballistic is they're going to make a ton of money being the custodian for half of these Bitcoin ETFs. Somebody's got to buy these Bitcoins and somebody's got to store them, in an electronic wallet in a safe way. And Coinbase is very well suited for that. And that's why their stock was up like 300% last year.
Okay, but new capital going into these ETFs means that end of the day, somebody's buying additional Bitcoin.
Right, exactly.
Okay. All right. Again, we could have an interview on every one of these things. All right. So I'm going to start wrapping it up here. I just want to flag, because you're a great guy to have these conversations with, and I really value your macro outlook on many things other than just the economy. And we've had many private discussions, including a pretty lengthy one right before we turned the camera on here on some of these issues. So I really hope at some point to get you back and talk about things like, you're there in Chicago, right? Where I think that's where the Democratic convention is going to be this year, right? So
Right.
we're in a presidential election cycle. As much as this isn't a political channel, we're aware that there are implications, to what goes on in politics. So would love to get your thoughts on kind of how the presidential race may impact macro and markets this year. A big thing I want to talk about with you is you and I are I think both very conscious of the wealth gap that's in this country that has been accelerating, and the trajectory does not seem to be getting any better. In fact, it continues to seem like we're increasingly bifurcating. And just sort of socially, what are the long-term implications of that? And is there any optimism that we can avoid getting to a breaking point socially, where just so many of those people, like I said, it's a story of the 80%, really probably like 90% versus everybody else. How worried are you about that trajectory and what might emerge from it? We were talking earlier about immigration. In fact, our broken / non-existent immigration policy right now, and just a lot of the sort of economic and social challenges that creates. So hopefully at some point, Jim, we can get you back on and really delve into those.
So just two real quick things. I am an optimist about the country because I believe what Winston Churchill said about Americans holds true, that America can be counted on to do the right thing after it's exhausted all other options.
Yep.
And we seem to be in the process of trying to exhaust all of the other options. And then all we'll be left with is do the right thing. But right now we're in the bad part of that. And the second one about the provocative thing is, I'll just throw this out for people just to kind of ponder. The Democrat convention is in Chicago this year in July. The governor of Illinois, J.B. Pritzker, was on some of the Sunday morning talk shows begging was his word. The governor of Texas to stop the immigrant flow buses that are dropping off immigrants in Chicago and all the other northern cities, but especially Chicago, because it's below zero and all this other stuff. There is a story out there that those buses aren't going to stop coming to Chicago because they want to make sure that there's as many homeless immigrants as possible on the streets of Chicago for the convention this summer. And so we'll have to see if that's indeed what seems to be happening. But here we are in January, and I hear the governor of Illinois begging the governor of Texas to stop the buses. And the governor of Texas has a very good answer. You know, the governor of Illinois said, why don't you give us 36 hours notice? And his answer was, as soon as I get 36 hours notice that they're going to walk over the border into Texas, I'll give you 36 hours notice as well. So you want to be a sanctuary state, this is part of being a sanctuary state. This is a big issue. And the last thing I'll say real fast, the night before we were recording was the Iowa caucus. In the polls of people going into the caucuses, among Republicans, far and away, the number one issue in the country is immigration. That is number one by a long way. Number two is a distant second to it. So this is going to be a big issue as we go through 2024.
All right. And it's one that I do want to talk more about on this channel. It is a sensitive issue. I think it's hard to do without inflaming emotions kind of on all sides, but it is a real issue. And it's one that we're going to just need to be able to have an adult discussion around. So folks watching, don't be surprised if I, begin to bring in some people or ask the opinions of folks like Jim, because it's not going to go away by not talking about it. And it's already, as Jim said, it's I guess, at least for Republican voters, number one issue for them. So it's something that's going to impact the future of the governance of this country. So anyways, all right, Jim, well, look, a couple wrap-up questions. First one, where can folks follow you in your work? They've enjoyed this discussion. They want more Jim Bianco. Where should they go?
Research site is biancoresearch.com. The ETF site is biancoadvisors.com. I'm active on Twitter and LinkedIn and YouTube. You can find me at Bianco Research on Twitter, at Bianco Research on YouTube, and under my name, Jim Bianco on LinkedIn. Quick word about Twitter, like probably you too, Adam. I got a lot of scam accounts that use my name and likeness. So make sure you find the one with the blue check mark and 370,000 followers. I only say that so you get to the right one. If you're following me and if you follow me and it's got 38 followers, you're not following me.
All right, I'll put the handle on the screen so folks know the right one. I'll also put the links in the description so folks can one-click their way there if they want to. And just a reminder, both for Jim and me, if you ever get contacted by Jim or me over social media and we're soliciting something from you, it is definitely not us. That is definitely a scammer.
Right. I'm never going to DM you and tell you to send me money. I'll tell you in a public way about my ETF, but I'm not going to tell you in a DM to send me money.
Put your hand out there publicly about the ETF. Got it.
Right.
All right. So I'm getting to the very last question to you, Jim, which is going to be, look, we've just spent the hour talking all about money. What's one non-money related investment you would encourage folks to adopt in their lives? All right. Well, just in wrapping up here, the Thoughtful Money Conference date has been written in stone now. That's going to be Saturday, March 16th. More details on how to register for that, get the early bird price and all that stuff coming up. Stay tuned. Hopefully should have that for you in less than a week. A reminder that if you are a premium subscriber to my Substack, adamtaggart.substack.com, not only do you get a bunch of content for free during the week about everything that's going on here at Thoughtful Money, but amongst the other benefits, your premium subscription will serve as a discount card to the conference. So no matter what discounts we're offering as we get up to the final full price for the conference, you'll get an even lower price because you're getting an additional discount tacked on by being a premium Substack subscriber. All right, and if you have enjoyed this conversation with Jim even half as much as I have, and it's been amazing as usual, Jim, and would like Jim to come back on and hopefully tackle some of those other big issues I talked about, please let him know by hitting the like button, then clicking on the red subscribe button below, as well as that little bell icon right next to it. All right, Jim, we're at you for the last question here. What's a non-monetary investment you would encourage people to consider adopting?
Their health. And I would say, look, find something you like to do physically. Dance, run, hike, jog, bike, ski, golf, tennis, fill in the blank. And don't be afraid to spend some money to do it. Because if you get yourself in better health, that is probably going to be the best return best returns you will ever find in any investment you have.
Great point. Something a drum I beat on this channel a lot, and I love that about your point about don't be afraid to spend money, because the ROI is really about the best you'll find, and you'll really notice that return the older you get, right? When you're looking around at your peers who didn't invest in themselves and say, "Oh my God, I'm so glad I took this seriously." But what I find too is a lot of people will oftentimes have the intent, like, yeah, I'm ready to do this, but they don't necessarily have the experience base or knowledge base. And so they kind of just try a couple of things. And then after a while, the initial motivation peters out and you're right back to where you were. Whereas if you hire, a good coach, or you go to a gym with a good coach, or you hire a nutritionist to help actually put together a real plan for you, that stuff becomes a lot more sustainable long term. And those people can really get you over that early failure hump that so many people fall into. You're not
Yeah, and also do something you want to do. Sometimes what happens with people is they take up, I'll take up running, because that seems like a good way to get into shape without spending much time. And then you just find out it's just not for you. And that's fine. There's a bunch of other things you can do besides that. And you find whatever it is, like I said, maybe it's dancing or anything that you just get out and move. And once you find something you like and you want to do, it's not that hard to do it.
Great point. Yeah. Do what you like, do what works for you. All right. Well, look, thanks so much, Jim. This has been wonderful. Good luck on the ETF.
Thank you.
Love to have you back in the program again soon. Like I said, folks, if you've still got some stamina left, I talked with Andy Constant. That was the video right before this one. And if you really want to understand like the mechanics of how the reverse repo program works, or the BFTP, the bank funding term program that the Fed put in place to stem the banking crisis last year, that is now coming up for expiry. And a lot of, there's a lot of debate whether that's going to be a big thing or a nothing burger. Andy goes deep into that. So again, if you've got some stamina, I'll put up a link to that video right here. Thanks so much, Jim. Everybody else, thanks so much for watching.